Welcome to Stony Finance Lab channel.
Hi, everyone. This is Team 2. My name is Robert. Our topic is Passion FIRE. FIRE stands for Financial Independence, Retire Early. And we are Jovher, James, and myself. Our keywords are asset allocation, diversification, budgeting, financial freedom, and risk management. What is financial freedom? Passive income. Our money is now working for us as opposed to us working for our money, whether that be in our careers or side hustles. It's stress-free. Money feels like a tool. It's not a restriction anymore. It's life on our terms, not having to worry about going to a 9-to-5 job, having other opportunities to pursue our passions or other goals. And to follow up, pursue a passion, be able to pursue your passions and goals. For our background, our targeted investor group is college graduates in business living in New York. The investment goal, financially free after 20 years and able to pursue a passion. And our investment vehicle, a brokerage account. So for our targeted investor group plus investment goal, like we just said, we're using a scenario base of a business graduate living in New York, starting salary of an average of $65K, and the goal investing and pursuing a passion. So we're going to start off by saving 30% of our income, focus on living frugally, and using investing as a tool to reach the ability to pursue a passion as an income. Investment strategies and lifestyle. Focusing on living frugally and investing 30% of income each year. Investing in portfolios that track different asset classes based on risk aversion and broad diversification. And the scheduled reinvestment into the portfolio over 20 years for maximum growth. Here we have an image of portfolio allocations based on risk aversion. As you can see, the low risk investments would be short-term investments, such as CDs or money market accounts. And as you go up towards higher risk, you have US stock, foreign stock. Things are a little more volatile, but deliver higher returns as well. And then, bonds are right in the middle. For our chosen allocation, we did 70% equities, 30% bonds. And on the right side, you can see a range of stock, bond, and blended total returns for a 1-year basis, a 5-year rolling, a 10-year rolling, and a 20-year rolling. We can see the worst return is 7% based off this. An average would be 13%, and best would be 22% in a good period. For our pre-retirement, so this would just be starting out, graduating, getting a salary of $65,000. Saving 30% would leave us with $19,500, and we have a randomized return percentage over the initial 20 years between 5% and 22%. This is done via Excel with the function ran between. And so we have zero withdrawals for this 20-year period, a constant 30% savings, and an income growth rate of 5%. So from year 1 to year 2, we see a $3,800 and $250 salary increase. And from there forward, it's a 5% increase based on general guidelines of pay increases plus to keep pace with inflation rises. So we can see here at the end of 20 years with a randomized return between 5% and 22% and a 30% savings rate, we can wind up with approximately $3 million at the ending balance. So now at year 21, this is post-retirement. You are about 42 to 46 years old, depending upon what age you graduate college. You have an initial balance of approximately $2.9 million. At this point, we will start withdrawing approximately $80,000, and it's based on an inflation rate each year, 1.5 to 7% increases or decreases in between that range. We still we now set our portfolio at a lower risk, more conservative approach, and that would be between 3 and 6% randomized. And so if, for instance, our initial balance is 2.9 million, our return would be 3% minus the withdrawal of 80 grand. We would have an ending balance of 2.9 million still, a little bit more than our initial balance by about $5,000. And from that point, at this age range between 42 and 46, we're able to pursue a passion. So assuming a passion business starts off and we yield 15,000 to 30,000 yearly, we still would maintain 95,000 to 110,000 a year. With that being said, we would aim to relocate to a low-cost area, for example, Florida, North Carolina, Ohio, states that are tax-friendly, mainly Florida there. And then, looking past retirement, when we get to year 50, approximately 72 to 75, donate money to family, so leave a legacy, charities that we care about, and our university. Mistakes to avoid. So this is hypothetical growth of $10,000 investing in the S&P 500 index between January 1st, 1980 and December 31st, 2018. And so we could see missing out on the best days of the markets can cost investors, right? So missing best 50 days, your $10,000 is $57,000. Missing investing in all days, you'd have 659,000 versus missing the best 5 days, you'd have $426,000. So we could see, different levels of maybe the market was going down at certain points during these years, which it must have been. People might panic sell their investments, try to time the market. There's an old saying, timing the market beats trying to time the market. And so, the safest thing a long-term investor can do is keep their money in the market, doubling down and just setting that scheduled investment so your money keeps compounding. Because the times you try to take it out of the market and put it back in the market based on news or media is mostly based off fear. And you don't ever want to trade your investments when you're in a fearful state. You always want to keep a level-headed mind and be calm. Principles for success. So we have diversification. The more stocks, sectors in a portfolio, the less weight each holds. So your risk is diversified. You have a broad exposure. So you minimize your risk of one company, one sector doing bad. Maybe there's poor earnings, maybe money management within an organization, and it hurts your portfolio. Budgeting. Watching what you spend and how you spend will allow you to save and invest more money in the long run. So your wants versus needs. Do you really need that new Lexus, or can you go with the Toyota Corolla and save in the long term? Have goals. Know how much you want to have in your portfolio to retire with financial freedom. It's always easy when you have a definitive number in your mind, whether you're going to move out of state or move out of country or live in the same state you live in. You're going to need to maximize your portfolio by investing and having that goal. And investing earlier. Investing early allows you to compound your money longer, and which just leads to higher growth. In summary, we have investment. Schedule investing, portfolio allocation saves time and thinking. Let it go on autopilot. You don't have to pick all your investments. You can put it in an ETF or an index and just keep that scheduled investment going over time. Financial freedom allows you to pursue your passions and your goals. It's better to create the lifestyle you want to live instead of working constantly 9 to 5, and saving and investing, prioritizing right now. What's going to matter most when you're older is the most important. Your lifestyle. Like I just said, prioritizing lifelong savings instead of living above your means at this age. Maybe you're trying to keep pace or keep up with the Joneses, as they say. And then relocation. Moving to a low-cost area can help to maintain funds in the portfolio. Here are our sources cited, and thank you for your time. Have a great day.
Thank you for watching this video. Please feel free to like, comment, and subscribe to this YouTube channel.